This week on Wealth Track, all the reasons to be bullish with noted Fed watcher and strategist Ed Yardeni.
Any of these companies that are providing us with cloud technology, video conferencing technology, or providing the hardware to make this all happen are seeing their businesses explode to the upside. And that's been very apparent in the earnings reports that we've seen. So the market has actually been rational, not irrational yet, but has been pretty rational about which companies are benefiting from all this.
Ed Yardeni's bullish outlook on this week's Consuelo Mack Wealth Track.
Funding provided by Morgan Le Fay Dreams Foundation, ClearBridge Investments, Miller Value Funds, Royce & Associates, Matthews Asia, First Eagle Investment Management, and Strategas Asset Management.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Remember all the discussions about the shape of the economic recovery? Would it be a V? Would it be a W? Or maybe even a hockey stick? Well, the jury might still be out about the economy, but as far as the market is concerned, there is no question. V's abound. The S&P 500 has reached new highs. The top 5 S&P 500 companies by market capitalization, Apple, Amazon, Microsoft, Google's parent Alphabet, and Facebook, all but the last topping $1 trillion in market value, are sharply higher. Home building stocks have had a fantastic rebound, as have lumber and gold prices. None of this is a surprise to this week's guest, who turned bullish near the market lows. He is Ed Yardeni, a PhD economist, longtime Fed watcher, and investment strategist who is widely followed by institutional investors. Yardeni founded his own global investment strategy and asset allocation firm, Yardeni Research, in 2007, having held top investment positions at several major firms. He is also the author of a new book, Fed Watching for Fun and Profit, a primer for investors, which will be the focus of another Wealth Track. I began the interview by asking him how bullish he is.
Well, I was very bullish on March 25th, and I'm still bullish, but it's getting harder and harder to be bullish as this market just keeps melting up. Honestly, I've been kind of holding the tiger by the tail. I've been chasing this market up. On March 25th, after what the Fed did on March 23rd in the morning, I came out and I said, I think that made the low when the Fed came in with all their monetary easing. And it was the low on the 23rd. I was bullish. I said, I think we're going to go to 2,900. We were around 2,200, 2,300 at that point. So 2,900 looks pretty aggressive. And we got there in a matter of a couple of months. So I raised that to 3,500 for the end of the year. And we're just about there already. So for next year, I'm looking at 3,800, and everything seems to be happening ahead of schedule, which is consistent with my view that we're very likely in a melt-up situation.
And let's talk about the melt-up situation, because you've been comparing in your research reports the 2020s to the 1920s. Are there, historical parallels?
Well, of course, the big difference, let's start with the difference, is that the melt-up in the 1920s occurred at the end of the decade. But the similarities are there. We had the Spanish flu in 1918, and that was a killer. It was horrible. It was a global pandemic, and everybody obviously was extremely pessimistic. We were in a recession in the early 1920s. But then, as you know, the 1920s subsequently turned out to be great because of technological innovation. And the result was a huge bull market in the stocks that ended in a melt-up in the late 20s with a crash in 1929. This time, we may be starting the decade with a melt-up. That may lead to a meltdown, but doesn't necessarily mean that we're going to have another Great Depression. It just means that the economy is just getting ahead of the fundamentals. But the fundamentals could turn out to be equally as bullish in the 2020s as they were in the 1920s. The fundamentals of the 1920s was things like electricity, the automobile, refrigerators, plumbing, basic stuff that we take for granted. And a lot of that made our lives much easier. Driving a car was better than walking or taking a carriage or a horse. The current technology revolution that we're in could be equally as awesome in terms of our prosperity, in terms of just our standard of living up ahead here. And a lot of it really has to do not so much with brawn, which if you think about it, that's what the original Industrial Revolution was all about in the 1700s and the 1800s. This one's all about the brain. It's all about, using artificial intelligence, robotics, 3D technology to make things smarter, faster. And that could really be revolutionary.
So what do you do as a strategist when you're kind of looking longer term and you're saying, look, we've got all of this fantastic technological innovation going on, and yet values are kind of way ahead of themselves. So what do you do in the meantime at a time like this?
I mean, the reality is that in the early 1920s, they probably didn't have a clue in terms of what technologies were coming and how radically that would improve standards of living in the 1920s. I think we have lots of clues about 5G telecommunications and how that will enable all sorts of Internet of Things, including autonomous vehicles. But it's not like we haven't, the market hasn't figured this thing out. And maybe also because of what I call the great virus crisis, we've seen how important technology can be in allowing us to get on with our lives. Not everybody is as fortunate as those of us who can work from home, but I think we are making tremendous progress on the technological side, and the stocks have reflected that. But a lot of them has been the big cap names in technology and communication services, consumer discretionary. Everybody thinks of Amazon as a technology stock. It's actually in consumer discretionary. Right. And the problem with those stocks is they've been picked over. Everybody owns them. They're expensive. But you know what? As big as they are, they're still showing double-digit revenues growth and earnings growth.
We talk about them as being kind of the FANGs, but in fact, that you've got several terms for them. And I think the Magnificent Five being the five largest capitalization stocks in the S&P 500. So those, of course, are Apple, Amazon, Microsoft, Alphabet, the parent of Google, and Facebook. Right. And they're like, over 26% of the S&P 500 now versus the Magnificent Five in 2000. Microsoft, Cisco, GE, Intel, and Exxon, they were at the top of the tech bubble in March of 2000. They were only 18.5% of the S&P 500. Right. That's a big difference.
We're in the twilight zone. We've never been here before. We thought that things were pricey back in 1999, 2000. Actually, we should have thought with the benefit of hindsight, because it was a bubble and a lot of people said it's different this time. It's a new era. And there's some of that going on now. The big difference is a lot of the companies that are leading the way here in the market actually do have revenues, actually do have earnings, and have some really great prospects. And because of the great virus crisis, a lot of their optimistic trends that they were benefiting from have accelerated. Any of these companies that are providing us with cloud technology, video conferencing technology, or providing the hardware to make this all happen are seeing their businesses explode to the upside. And that's been very apparent in the earnings reports that we've seen. So the market has actually been rational, not irrational yet, but has been pretty rational about which companies are benefiting from all this.
What about the other 495 companies in the S&P 500?
Right. Look, I think there's probably a lot of value there if you believe that the 2020s have a chance of being like the 1920s. I mean, these five companies that have sort of dominated the headlines and have led the market up, a lot of the technological innovations are innovations that other companies are using. Look at retailers. We had lots of retailers that obviously have been shut down or gone bankrupt. But there were other retailers that got the message from Amazon that if you don't provide online ordering, you're going to be buried by Amazon. And so not all the retailers were buried by the great virus crisis. Some of them, like Walmart, for example, have generated tremendous earnings growth because they took the competitive challenge for Amazon. Amazon, in some ways, saved the retailers who realized that they had to provide at least an online alternative to coming to shop in the store. And it's worked very well.
In the first book you wrote, which was Predicting the Markets, and I interviewed you about that in 2018, and you said that you pride yourself on connecting the dots, connect the primary dots for us that underlie this bullish case.
Well, the biggest dot of them all is the Fed.
The Fed.
Absolutely. The Fed's always been key to my thinking about the economy, the financial markets, particularly the stock market. I haven't always been particularly good at calling corrections, and even in bear markets, a few of them I wish I had been more bearish. But the good news for me is bull markets tend to last a lot longer than bear markets, and I've picked some pretty accurate bottoms just by watching the Fed.
Right.
When the Fed says, "Oh my God, we're in a recession and we got to ease and provide a lot of liquidity," that's the bell.
Your latest book is called Fed Watching for Fun and Profit, and
Right.
you and I are going to devote an entire show to that because because of the critical role that the Fed
Right.
does play in the market. But aside from the Fed,
Right.
What else? What are the other big dots that you're connecting again that underlie the bullish case?
Once you sort of focus on the Fed, you can start looking around and saying, okay, how are these policies affecting the economy? How are individuals, how are consumers, how are businesses responding to the virus and to the policy response to the virus? And one of the clear winners here is anything housing related.
Right.
And
as you said, housing is on fire.
We've been waiting for a long time for the millennials to start acting like they're baby boomers, the baby boomers, and buy houses and have families and kids. The jury's still out on whether they're going to have more than one kid, but there seems to be a lot of anecdotal evidence of late that a lot of millennials who had been renters in urban areas are moving out to suburban and rural areas and are scrambling to buy houses. So housing starts, new home sales are very strong, existing home sales are very strong. And that in turn has a lot of knock-on effects on retail sales that are related to housing, like home improvement, lumber, gardening. And that could also be a big positive for autos. I mean, people who move to the burbs, that if they were lived in an urban area, they probably don't have a car. So there's a lot of positives for the economy. But on the other hand, the service economy is hurting badly. So anybody in restaurants, hotels, those kind of services industries where people have to physically be there have been hurting. Now, a lot of restaurants have outdoor seating now, but what's going to happen in the winter?
Right.
So we're not out of the woods on this thing at all.
Put on your PhD economist hat. Remember the big debate, is this going to be a V-shaped recovery, a W? Is it going to be a hockey stick?
Yeah.
Whatever. What's it turning out to be?
I'm staying away from the alphabet right now, using the Nike swoosh logo, where you go down and then you V up and then you start to swoosh a little bit. I don't really see the economy going back to where it was at the end of last year, which was the all-time record high for real GDP, maybe until the middle of 2022. I think the service economy is going to be slow to recover. And in many areas, it may not recover. Which means that companies, for example, in retailing that are the haves and figured out how to survive will get more market share. But that's still going to be hurting us in the labor markets. But boy, there's still a lot of misery in the labor markets, and a lot of that is in service-related jobs, and that misery could stay a while.
One of the things that you said, if you extrapolate 6% annual appreciation in the Dow, which is what it's been historically, that puts it at 45,000 by 2030. How possible is that?
Well, keep in mind, it's only a measly 6% per year, which some people don't view as what you should be getting for the market. Some people got used to getting double-digit returns from the stock market. All it just shows is what Warren Buffett's been saying for a long time, that the magic of compounding really gets you to levels that seem magical and impossible until you realize you're just compounding 6%, which has been the trend since the early 20s. I think the key here is inflation. There are people, including myself, who are kind of wondering, is this going to wind up like Weimar or Zimbabwe hyperinflation? Right. Or is it going to be more like...
Because of the incredibly expansive, unprecedented Fed action, all of the cash liquidity sloshing around the global system. I mean, we've never had it to this extent.
Yeah, I mean, if you just kind of based everything on what you learned in school, in school they taught us that inflation is a monetary phenomenon, and if you just pour buckets of liquidity into the financial system and the economy, you're going to get inflation. Well, we're not getting much in the way of price inflation. We are getting a lot of asset inflation, and that could lead to bubbles, which then could lead to meltdowns. But I don't think the Fed is going to be causing a recession anytime soon, because I don't think there's going to be an inflation problem. I think there's some very powerful forces that are keeping inflation down. I think the most powerful one is actually demography. And Japan, therefore, becomes kind of a more logical alternative to where this all leads.
So demography being the aging population and also declining birth rates as countries become more affluent, their birth rates decline.
Yeah, that's correct. There's other factors. Technology is disruptive and it's fundamentally deflationary. So I think that's another reason not to worry about inflation making a comeback.
Right. Now, globalization, of course, has been deflationary, but that's under attack, Ed.
Yes.
So, could that possibly bring inflation back if you can't buy cheap goods from overseas and you're basically repatriating industries back into countries where the labor prices are higher? What do you think?
Absolutely. Oh, I think that's a very good point. I call them the 4 Ds. And the first one is globalization. The problem is it starts with a G. So my wife is French, and she said, how about détente? Right? That works for me. So you're right. One of the 4 forces. The other are technological disruption. That's a D. And then demography. That's a D. And then debt. We're used to thinking of debt as being inflationary. But once everybody's kind of up to here in debt, and the Fed continues to provide cheap credit, a lot of it goes into creating too much supply, too many zombie companies that stay in business. But to your point, which is a very important point, globalization, global competition, the ability to produce things where labor is cheap has been a source of low inflation, deflation. However, I think technology is going to be very important here. I think there's going to be a move. There's already a move to bring supply chains back closer to home everywhere. And I think things like 3D manufacturing is certainly one very important technology that can make things happen at home.
Right, and that certainly would be disinflationary.
Absolutely would be.
The 3D manufacturing that's a revolution. That's the kind of revolution you're talking about.
I think that kind of innovation is not pie in the sky. I think it's something we can do today.
Going back to the market, what would cause you to turn bearish?
Well, at this point, I'm actually worrying about the melt up. The market just won't listen to me. I've been saying, this market really needs a rest. It really needs to consolidate its gains. We've only recently seen that analysts are starting to actually get a little bit more optimistic about earnings. It'll be healthier. If the economy just said, okay, let's see if we are getting out of this virus crisis. Let's see if it's a V-shaped recovery or whether there might be a double dip. Let's give it some time here to play out. But the markets get kind of running way ahead of all this, and a lot of it has to do with the simple fact that bonds just aren't really that interesting with interest rates near zero, and so a lot of people are continuing to rush into stocks. So that I am concerned about a melt-up.
Except, Ed, we say that, but in fact, the fund flows have still been largely into bonds.
I think some of that is munis.
Okay.
Yeah, I think that's an important part of it. There has been, I know in talking to my institutional accounts that a lot of them have been rebalancing out of bonds into stocks. And as you know, fund flows, you got to account for a lot of different players. And
Right.
the fund flows you're talking about are clearly mutual funds or ETFs. And a lot of people buy bonds directly. And so they might be selling them directly to buy equities. The big buyer of bonds, of course, has been the Fed. And there are a lot of institutional accounts that I speak to that say, okay, if the Fed wants them, I'll sell my bonds and
Sure.
I'll rebalance into stocks. A lot of them regret that they didn't do it faster. It was very hard to jump right back into this market after the kind of sell-off we had in February and March.
As far as individual investors are concerned, many of whom, of course, own index funds, many of whom therefore own a big portion of the FANG stocks or their equivalents, what do you think they should do?
Well, at this point, I think you just stay in the market. I mean, if you've been totally out and you're sitting there in cash, I don't know what to tell you. It's a little late to be jumping in here. And the problem with getting in here, if you haven't been in the market, is, for the first sell-off, you'll be jumping out because you just won't be able to take the pain. So I think for the most part, investors should just kind of stay put. That sell-off that occurred in February and March, in some ways, was a fortuitous one. It occurred so rapidly that people really didn't have a chance to panic out of it.
Respond.
If you've got too much in the Magnificent Five and the big tech companies, you may want to start to rebalance, as we like to say, into other areas in the market that have lagged behind. Healthcare still looks pretty good. I think healthcare has actually been held back by concerns about how politics will play out on November 3rd. But I think no matter how politics plays out on November 3rd, I think the prospect is pretty good for the U.S. economy. And again, I think the Roaring '20s was really fueled by technological innovation. And I think we've got enough technological innovation that will improve standards of living, improve prosperity, and earnings, which is really what drives. That's why the Dow Jones has been up 6% per year, is because that's been the trend of earnings.
We ask each guest at the end of every Wealth Track if there's one investment we should have in a long-term diversified portfolio, what would it be? And just as a reminder, in 2018, you said that it was invest in the global economy, and you said basically about 1/2 in U.S. stocks, 30% in Europe and Japan, and the rest, which would be about 20% in emerging markets. What do you think about that approach now, number one?
I don't really have any regrets. I think that's a good approach. I mean, the problem for global investors has been that if you didn't have a full weighting in the big tech U.S. stocks, you've underperformed, and that's been the problem for everybody. Whether you're small cap, large cap, or growth value, or stay home versus go global. Stay home used to mean invest just in the U.S. rather than what's happened since the virus. But I think you just really have to make a decision on what do you want to do with those large cap names. If you own them, if you've got enough of them, you may actually want to pare back and go more global. I would bet that the global economy will come out of this prospering, and I don't think we're going to find that world trade is shut off. There'll be some rearranging of supply chains, but I think it'll be very difficult for everybody to just kind of go it alone. And if you go it alone, you're going to miss some opportunities to sell to consumers abroad. So I would stick with that approach.
All right. So the one investment for a long-term diversified portfolio today would be, can you be more specific? Would there be a particular sleeve of that global approach that you would emphasize?
Well, I would still stick with the U.S., but maybe cut back on the big tech names. Go for just some of the smaller tech names. Maybe I think the large cap sector has really outperformed dramatically Really
It has.
it was really since 2018. And
Right.
I think there's opportunities here in small cap, mid cap technology, healthcare, industrials. You don't really have to take huge positions overseas to be exposed to the global economy. Even small companies here do 30 or 40% of their business on a global basis, and that's probably going to continue.
Ed Yardeni, always a pleasure to talk to you, and I look forward to a future program with you about your new book, Fed Watching for Fun and Profit. So look forward to that, and thank you for your time today, Ed.
Thank you, Consuelo.
At the end of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is don't fight the Fed. Or at least before you do, be darn sure you know what you are doing. Marty Zweig, author of the investment classic Winning on Wall Street, and a very successful analyst and investor in his own right, coined the phrase because he observed that, quote, the monetary climate, primarily the trend in interest rates and Federal Reserve policy, is the dominant factor in determining the stock market's major direction. Ed Yardeni and many other veteran strategists agree, as a general principle, don't fight the Fed is a good place to start. Next week, retirement pro Mary Beth Franklin addresses the pandemic's impact on retirement planning and how to adapt. In this week's extra feature, Ed Yardeni explains why COVID-19 has not changed his work life at all. Whatever your situation, we appreciate it when you connect with us on Facebook, Twitter, and our YouTube channel. Thank you for spending your precious time with us. Have a super weekend and make the week ahead a healthy, profitable, and productive one.